In this lecture, we'll talk about the Federal Reserve System or the central banking. So, what is a central bank? It's an organization responsible for conducting monetary policy and ensuring that nation's financial system operates smoothly. Now, what is this term monetary policy? It essentially means that controlling money supply and interest rate. Now, interest rate you pay on your student loan, interest rate you pay on your mortgage, interest rate you pay on your electronics that you buy if you are borrowing money to buy anything. It's determined by the Federal Reserve, and based on the Federal Reserve's interest rate, banks determine how much interest rate to charge you. So if Fed increases the interest rate or central banks increases the interest rate, what we end up having is this higher cost of borrowing. In the US, the central bank is also called Federal Reserve, or in the short, the Fed. It is a semi-decentralized mixing government appointees with representation from private sector banks. So it's a semi or quasi-government institution where we have representation from the government and also representation from the private sector. It's run by the Board of Governors, consisting of 7 members appointed by the President of the United States and confirmed by the US Senate. So anybody who is serving in the Board of Governors has to be appointed by the President of the United States and also needs to be confirmed by US Senate. So next I would like to talk about something called Federal Reserve Banks. In US there are 12 Federal Reserve Banks, each of which responsible for supporting the commercial bank and economy generally in its district. And you can see here the whole country is divided into 12 districts, and each district has a separate Federal Reserve banks, and all of these 12 Federal Reserve banks come under Federal Reserve System. So your Federal Reserve System consists of 12 Federal Reserve banks and Board of Governors. Now, Board of Governors are people who sit in the Washington DC, right here in this map. That's where the Board of Governors are based. And each of these districts, that 12 districts, has a Federal Reserve Bank, and they are responsible for supporting and also regulating the commercial banks in their areas or districts. For example, New York itself has its own Federal Reserve Bank, which is based out of New York City, and they control all the Wall Street banks and all the banks in the state of New York. Now, question is this: what does Federal Reserve banks do, or what does central banks do? Federal Reserve is designed to perform 3 important functions. The most important function is to conduct monetary policy, which essentially means that controlling money supply and interest rate. Second, to promote stability of the financial system through bank supervision, deposit insurance, lender of last resort. And we'll be discussing all what does deposit insurance or lender of last resort means. Finally, central banks provide banking services to commercial banks and other depository institutions, and to provide banking services to the federal government. So you can say central banks are bankers' bank, is the bank for the banks. You and I cannot go and start opening an account in a central bank. However, a bank, if you're running a bank, your bank can be part of the central banking system. Before I move on, let me little bit discuss about deposit insurance and lender of last resort. What does it mean? Now, bank run or bank failures. So bank run, also called bank failures. It happens when depositors race to a bank to withdraw their deposit for the fear that otherwise they would be lost. So we all deposit money in a bank. Now the way banking model works is this: we don't go one night and withdraw all our money, or rather, we don't go, all of us go at the same time and try to withdraw money. I might need $20 today, you might need $20 tomorrow. So, if I need $20 today, I'll go up to the bank and withdraw my $20. But if you need $20 tomorrow, you might go to the bank tomorrow and withdraw $20. So, we don't want all of us to go to the bank at the same time and try to withdraw money, because our money has been loaned out, as we discussed in our previous lecture. So bank really doesn't have all the money available to pay us back, because they are working as loans to the borrowers. Now, since we don't all of us show in a bank to withdraw money, so banks can support banking by keeping a reserve, which is a part of the total money they need to keep in their vaults to carry out their day-to-day transaction. Now, bank runs is a situation when everybody shows up in a bank and try to withdraw their money. And obviously, banks do not have all the money available at that point of time. And since they can't pay all their customers, it's called bank run or bank failures. And the risk of bank runs can create instability in the banking system, because it can happen because of rumors, because you heard your neighbor said that your bank is failing, you just show up in a bank, and rumors do spread pretty fast, and as a result it's a problem and it creates instability. So what we have done to protect bank runs, Congress put two strategies into place. First one, deposit insurance. This is an insurance system that makes sure depositors in a bank do not lose their money even if the bank goes bankrupt, and it is called FDIC, or Federal Deposit Insurance Corporation, which ensures that your money in a bank is protected up to a certain amount. Another role that Congress created is a lender of last resort, which is our central bank. This is an institution that provides short-term emergency loans in conditions of financial crisis. So basically, if a bank runs out of money, they need a quick flow of money, then they go to the central bank and borrow money. And often central banks are lenders of last resort because their interest rate is typically much higher than the borrowing that perhaps bank can do from the outside market. And we'll be discussing all this later on when we'll be talking about monetary policy. Next, I would like to talk about Fed's tools for monetary policy. How do they control the money supply? And the Fed has three tools available. One is open market operations, second is change in reserve requirement, and third is change in discount rate. So let's first start with what is open market operations. When central bank selling or buying treasury bonds to influence the quantity of money and the level of interest rate. Now, how does it happen? Now, central banks or Fed can issue bonds or sell treasury bills, which is the bond issued by the US federal government. Now, when they sell bonds, people like you and me go and buy those bonds and pay them in cash. So Fed can collect all those cash and put it in their vault, which essentially means that they are taking out money from the system. So when Fed sells bonds, it decreases money supply. On the other hand, if Fed wants to increase money supply, they might start buying bonds. So Fed can go out and start buying bonds from people like you and me. So they pay us in cash and they buy the bonds, and we take this cash and put it in our bank. And we all know when you put your money in a bank as deposit, how it ends up increasing money supply. So here's the bottom line. To increase money supply, Fed buys government bonds from public and banks. Mind you, banks also hold a lot of bonds. To decrease money supply, Fed sells government bonds to public and banks. So this is called open market operations, where they're buying and selling government bonds. Second is reserve requirement. This is the percentage of each bank's deposits that it is legally required to hold either as cash in their vault or on deposit with the central bank. Now, more cash that banks are holding in their vault, which means less money available to lend out, which means less money supply. So greater reserve requirement typically implies less money available to lend out, which essentially means that decreased money supply. On the other hand, smaller reserve requirement means that greater amount of money available to lend out, which means increased money supply. So to increase money supply, you have to reduce reserve requirement. To decrease money supply, you have to increase reserve requirement, which means that how much money that banks needs to keep in their vault to carry out day-to-day transactions. Finally, I would like to discuss a little bit about something called discount rate. Remember, Fed is our lender of last resort, and discount rate is the interest rate that Fed charges if banks wants to borrow from Fed. So discount rate is the interest rate charged by central banks on the loan that it gives to other commercial banks. If a central bank raises the discount rate, then commercial banks will reduce their borrowing of reserves from the Fed and instead call in loans to replace those reserves. Since fewer loans are available, the money supply falls and market interest rate rises. If a bank needs money, they can go to a central bank or the Fed in the case of US and borrow money at a discount rate. If the discount rate is too high, what banks can do? They can recall their loans. And recalling means that they're telling their borrowers that they have to pay back early. When the loan is recalled, that means less money in the system, and since there's a less money in the system, it decreases money supply. If central bank lowers the discount rate it charges to the banks, the process works in reverse. That means if you want to increase money supply, you have to decrease discount rate. So another way to put it, when the discount rate is higher, that means the interest rates in the market is higher. When the interest rate is higher, I would not like to borrow money to buy a new car or buy a new house because I have to pay more on my loans. As a result, I will not demand more money from the system. As a result, money supply decreases because banks will not be able to make loans to me. Again, remember, when banks make loans, they increase money supply. So these are the three tools, which are open market operations, reserve requirements, and discount rates, are the three tools or three levers that Fed or the central bank uses to control the monetary policy in the US.